for a moment, step back and look at what the market is actually reacting to. Because the surface story is gold hovering near $5,110 per ounce after 2 sessions of decline. But the real story unfolding underneath is much larger than a simple move in precious metals. What markets are quietly trying to process right now is the convergence of 3 powerful forces at the same time. The intensifying conflict in the Middle East, a renewed energy shock with WTI crude trading around $95 per barrel, and the growing realization that the Federal Reserve may not be able to cut interest rates as quickly as investors once hoped. When Donald Trump states that preventing Iran from acquiring nuclear capability matters more than oil prices, the tone of the conversation immediately changes. And when Mojtaba Khamenei signals that the Strait of Hormuz could remain effectively closed, the implications become much larger. Because at that point, the story stops being about a regional conflict. It begins to look like a systemic economic risk. After all, roughly 20% of global oil flows through that narrow corridor. And when that artery tightens, energy costs ripple through every layer of the global economy. Once energy begins pushing inflation expectations higher again, institutions like the Federal Reserve, the International Energy Agency, and central banks around the world are forced to reassess their policy path. And in moments like this, markets are not merely pricing gold or oil, they are attempting to reprice the entire financial system at once. And that realization may only be the opening chapter of what comes next. Now let's slow down for a moment and look at the piece of the story that may matter even more than the gold chart itself, the energy shock quietly unfolding in the background. WTI crude is now trading near $95 per barrel, not because of a routine supply imbalance, but because one of the most critical arteries of the global energy system is under threat. The Strait of Hormuz, the narrow corridor through which roughly 20% of the world's daily oil supply flows, has suddenly become a geopolitical pressure point. Iran's new supreme leader Mojtaba Khamenei has warned that the passage could remain effectively closed as the conflict escalates. While President Donald Trump has signaled that containing Iran's nuclear ambitions takes priority over concerns about oil prices. The result is a chain reaction across the global economy. Tankers are struggling to unload cargo from the Gulf. Shipping insurance costs are surging, and according to the International Energy Agency, the disruption is now large enough to trigger the coordinated release of 400 million barrels from strategic reserves. The largest intervention in the organization's 50-year history, yet even that move has failed to calm the market. And when the largest emergency release on record cannot push oil lower, the message from the market becomes difficult to ignore. The disruption may be far bigger than policymakers are prepared for, and that realization is where the next phase of this story begins. But the next piece of the puzzle may be even more important. Because once energy shocks enter the system, the conversation quickly moves from geopolitics to monetary policy, and that is exactly where markets find themselves now. Investors are watching the Federal Reserve far more closely than they were just a few weeks ago. The upcoming PCE inflation report, the Fed's preferred gauge, suddenly carries far greater weight. Because it will help determine whether policymakers can realistically begin easing financial conditions this year. Right now, the message from the interest rate markets is becoming clearer. Traders see almost no chance of a rate cut at the next FOMC meeting, and even by the end of the year, the probability of a 25 basis point reduction is only around 70%. At the same time, the broader macro data has not shown the kind of weakness that would normally force the Fed's hand. Weekly jobless claims fell to 213,000. Housing starts unexpectedly climbed to 1.487 million units, and the US dollar index has pushed to a 3.5-month high as Treasury yields rise. When the dollar strengthens and yields move higher, assets like gold often face short-term pressure despite geopolitical turmoil. In other words, the market is now wrestling with 2 competing forces at once: the uncertainty of war and the discipline of monetary policy. And how those forces interact may shape the next phase of the global financial cycle. And this is where the story becomes more complex than many headlines suggest. A lot of people instinctively assume that war automatically means higher gold prices. History does show that pattern at times. But markets rarely move in straight lines. And what we are watching right now is a moment where several powerful forces are colliding at once. Yes, geopolitical tension between the United States, Israel, and Iran has intensified. Yes, energy prices have surged, with WTI crude hovering near $95 per barrel. As uncertainty surrounds the Strait of Hormuz, the corridor responsible for roughly one-fifth of global oil trade. But that same surge in energy prices is also reigniting inflation fears across the financial system. And when inflation expectations begin to rise again, institutions like the Federal Reserve cannot easily pivot toward aggressive rate cuts. Higher inflation tends to keep interest rates elevated, which in turn strengthens the US dollar and pushes Treasury yields upward. Those forces create a headwind for gold in the short term, even while the geopolitical backdrop remains supportive. So what the market is grappling with right now is not a contradiction, but a transition. A moment where safe haven demand and tightening financial conditions are pulling in opposite directions, and understanding that tension may be the key to interpreting what the metals market does next. But beneath the noise of daily price movements, there is another force quietly shaping the long-term direction of the metals market, and that force is the steady accumulation taking place at the level of national reserves. While traders on futures exchanges react to interest rates, oil shocks, or geopolitical headlines, central banks have been moving with a much slower and more deliberate rhythm. One of the clearest examples comes from the People's Bank of China. Recent data shows that China added roughly 40,000 ounces of gold in January, bringing its official reserves to about 74.19 million ounces. More importantly, that purchase marked the 15th consecutive month of gold accumulation. This matters because central banks do not buy gold for short-term speculation. They buy it as a strategic asset, a form of monetary insurance in a world where currencies, interest rate policies, and geopolitical alliances can shift unexpectedly. At the same time, institutional demand remains visible through investment funds, with gold ETF holdings reaching their highest levels in 3.5 years earlier this year. These flows may not move markets overnight, but over longer cycles they often act as a structural foundation beneath prices, and when that quiet accumulation continues during periods of uncertainty, it tends to signal something deeper about how the global financial system itself is evolving. But to really understand the mood of the financial system right now, we also need to look beyond commodities and into the equity markets, because stocks often reveal how investors are interpreting the broader economic story. In the most recent session, the Dow Jones fell 1.56%, the S&P 500 dropped 1.52%, and the Nasdaq Composite slid 1.78%, with all three indices closing at their lowest levels since November. 8 of the 11 sectors within the S&P 500 ended the day in negative territory, led by declines in industrials, consumer discretionary, and healthcare. And the catalyst behind that shift was not a single earnings report or corporate event. It was the same macro force we discussed earlier: the sudden surge in energy prices as tensions in the Middle East intensified. When WTI crude moves toward $95 per barrel, and the Strait of Hormuz becomes a focal point of geopolitical risk, investors begin to reassess the entire growth outlook. Higher energy costs ripple through supply chains, transportation, and consumer spending, tightening financial conditions even before central banks take action. In moments like this, equities often become the first market to reflect rising uncertainty. And when stocks begin to weaken while safe haven demand quietly builds, it usually signals that the global financial system is entering a more fragile and unpredictable phase. But when we shift from the macro headlines to the structure of the gold market itself, another layer of the story begins to appear. In the short term, the charts are starting to show signs of tension. Recent price action suggests that spot gold may be forming a small bearish flag pattern, with the market recently slipping toward $5,105, briefly testing the 20-day moving average after being rejected near the upper boundary of the formation. More importantly, the sharp break from a previous rising wedge earlier in the week pushed prices down to roughly $4,996, a level that has now become an important short-term support zone. If that support were to give way, technical projections begin pointing toward a deeper consolidation area between approximately $4,592 and $4,402, a region that also aligns with the 100-day moving average, which has acted as a key trend support since late 2023. But it is important to interpret these signals within a broader context. Technical corrections are not unusual in strong bull cycles. In many historical cases, gold rallies sharply, pauses, retraces part of the move, and then resumes the larger trend once the market digests the new macro environment. And with geopolitical tensions unresolved, central bank demand still strong, and energy markets under stress, the current pullback may be less about the end of a trend, and more about the market recalibrating before its next decisive move. So when we step back and connect all of these signals together, the real question facing the market becomes much larger than whether gold rises or falls in the next few trading sessions. What investors are actually trying to understand is how the global system itself is adjusting to a chain reaction of events. It begins with geopolitics. The conflict involving Iran, the United States, and Israel, now entering its second week, threatens the stability of the Strait of Hormuz, the narrow passage responsible for roughly 20% of the world's oil trade. That tension has already pushed WTI crude close to $95 per barrel, reigniting fears that energy-driven inflation could return. And once inflation expectations begin to shift, the implications quickly move into the realm of monetary policy. The Federal Reserve now faces a more complicated environment, where cutting interest rates too quickly could amplify price pressures, just as global supply chains are under stress. That dynamic strengthens the US dollar, lifts treasury yields, and introduces volatility across asset classes, including precious metals. At the same time, structural forces such as central bank gold accumulation continue quietly in the background, including the People's Bank of China raising reserves to 74.19 million ounces. In other words, the metals market is no longer responding to a single headline. It is responding to an entire system in transition, and the next chapter of that transition may already be beginning to unfold.